Not even a year after the collapse of Silicon Valley Bank and First Republic Bank, another banking crisis is emerging. There are fears that more regional banks might fail, with New York Community Bank already losing over half its value recently. Jerome Powell's remarks suggest smaller banks may need to close or merge due to dropping property values. It's important to understand what's happening, how it might affect you, which banks are at risk, and what steps you can take to protect yourself. If you find this information useful, hitting the like button or subscribing would help share this video with others who might not be aware of the situation. To begin, let's simplify the original banking crisis. Banks use a system called fractional reserve banking, where they only need to keep 10% of deposits available for withdrawal. It's like if you give me $1,000 to hold, but I lend out $900 of it to someone else. And this process repeats. This system works well as long as new deposits keep coming in to cover withdrawals. It benefits us by allowing access to loans and earning interest on our deposits. However, it relies on the trust that not everyone will withdraw their money at the same time. Banks invest your money in safe assets, not just lending it to other banks. This ensures they can give you your money back with interest, as long as those investments are held to maturity. But there was a twist during 2020 and 2021, when interest rates were at 0% to stimulate the economy during shutdowns. This led to banks having a lot of money, which they invested in low-yield US Treasuries. When the Fed started raising rates, the value of these investments dropped. Normally, this wouldn't be a huge problem because the banks still have the money until the investments mature. However, smaller banks faced a crisis when their customers started withdrawing their money all at once, leading to bank failures. Today, a similar issue is happening, but with banks having their money in commercial real estate, which is also facing challenges. During a period when government bonds offered very little return and bank deposits paid less than 1% interest, commercial real estate was very attractive. You could take out a loan at 1 to 2% interest to buy a property that could yield a return of 3 to 4%. As a result, commercial real estate prices jumped by 10 to 30%, depending on the property type, with banks providing many of these low-interest loans because they had a lot of money. However, with the fastest increase in interest rates in history, commercial real estate values are dropping fast. Morgan Stanley predicts the market could fall by 40%, similar to the 2008 financial crisis. This situation is particularly problematic because US banks have around $2.7 trillion in commercial real estate loans, 80% of which are held by smaller regional banks, not considered too big to fail. Unlike residential mortgages that are fixed for 30 years, commercial real estate loan rates often reset after 3 to 7 years, similar to the adjustable rate mortgages common in 2005. Over $2.2 trillion of these loans will need to be refinanced by the end of 2027, putting regional banks at risk if they cannot collect on these loans. Commercial real estate values depend on the income a property generates and current interest rates. Higher interest rates mean investors need a higher return, which lowers property values. Recently, New York Community Bank reported an unexpected loss of $552 million, partly due to expected losses from commercial real estate loans. Deutsche Bank in Germany also set aside $133 million to cover possible defaults on its US commercial real estate loans, which is over 4 times what it reserved last year. This situation raises concerns that problems in the commercial real estate market could spread, lowering property values even more. When properties in financial trouble are sold, it can decrease the value of nearby properties and lead to a wider drop in prices. Jerome Powell mentioned that some smaller regional banks are highly exposed to these challenges and that addressing this issue could take years. One of the hardest hit sectors is office space. With more people working from home, 19.6% of all office space is now empty, the highest level since 1979. Many older office buildings struggle to attract tenants, and a significant number of office leases are set to expire by 2026, which could lead to even more vacancies and lower rents. Additionally, 25% of loans for office buildings are due soon, and with interest rates now much higher than before, the cost of owning these buildings will increase significantly. The National Bureau of Economic Research found that about 14% of all commercial real estate loans and 44% of loans for office buildings are in negative equity, meaning the loan amount exceeds the property's value. This increases the chance that borrowers will default on their loans, which could particularly impact smaller banks that might not withstand these losses. This situation poses a real concern for the financial stability of these banks. The biggest worry for banks right now is if inflation increases, causing the Federal Reserve to keep interest rates high and leading the US into a recession. This scenario could make it hard for borrowers to pay back their loans. However, Jerome Powell mentioned that although there will be losses for owners and lenders, the economy is strong, the job market is doing well, and inflation is cooling down. He believes the economy is in a good place and can improve. Interestingly, not all areas of real estate are in trouble. Certain segments, like warehouses, industrial spaces, and hotels, are doing quite well with low vacancy rates and high revenues. Most commercial real estate debts can meet banks' refinancing standards, and delinquency rates are only slightly higher than before the pandemic. However, office space is an exception, with a significant portion of office loans expected to fail, leading banks to be more cautious with their lending. This cautious approach by banks could affect you next time you apply for a loan for a house or car. If you're considering investing in real estate, it's wise to take your time, make thoughtful offers, and carefully assess if a property is a good long-term investment. Real estate can still offer great opportunities, but expect banks to be more conservative with loans. For those with money in regional banks, there's a small risk, as shown by past bank failures and bankruptcies. However, FDIC insurance has protected customers' deposits, with losses primarily affecting investors and stockholders. So unless you have more than $250,000 in a regional bank, your deposits should be safe. It's worth noting that while New York Community Bank's share price has fallen significantly, there hasn't been unusual deposit activity according to Bank of America analysts. Lastly, remember, this is just one perspective, and it's always best to consult a professional for advice specific to your situation. While it's important to be informed about potential banking crises, customers haven't lost deposits in recent incidents, suggesting some level of safety in the banking system. If you haven't already, please hit the like button and subscribe. Thank you so much for watching. And please, keep in mind this video is not financial advice and is for entertainment purposes only.